Hey guys, welcome to the Bold Effects. Today, guys, what I really want to talk about is, the difference between subject to transactions and loan assumptions. Okay, guys, so the reason I want to talk about that is because I am working on a lead in Atlanta, and this is, a lead from a realtor. And as I was explaining the process, right, as I was explaining the process of subject to, I was explaining the mechanics, seller finance. Obviously, for those of you that have worked with realtors before, this is like a concept out of the universe for them, right? They don't do this a lot. They only know cash transactions, right? Some of them are kind of familiar with seller finance, but there's a lot of education that comes into the picture when you're dealing with realtors. So you have to take your time, educate them about the mechanics, how it works. You literally have to become a coach almost for the unicorn agents that are actually willing to listen, because there is actually a lot of them out here that actually they're not even open to the idea. They're not even willing to listen to you. I don't waste time with those. I'm talking about the ones that are actually wanting to listen to you. They're giving you a chance, right? And they're open for you to provide, kind of out of the box type of solutions for their sellers because they really care. Now, the thing with realtors is the first thing you want to address is their commission, obviously, always. And I completely understand because that's how they make money, right? So you want to make sure that you address that their commission will be taken care of. You will pay them their commissions without a problem, right? That's the first thing they care about before you get into any other explanations. But with this specific realtor here, I've been talking with her for 3 days. The first time we talked, we were talking about two properties. One of them was a hybrid. What is a hybrid, guys, is when there is a mortgage in place, and then but there is also equity. So we have one side of the transaction is where we do subject to, meaning we take over the mortgage on that property, we take over the mortgage payments, and then on top of that, we give a down payment to the seller on that equity portion, and then we pay the seller their equity over time. So every single month, on top of paying the mortgage, we're also paying their equity every month, right? So we have two payments essentially per month, right? That's a hybrid. And then she had another deal that she couldn't sell. If you guys been following a little bit on what's going on in this market, the interest rates keeps hiking. So many properties are staying on the market, completely not selling, right? Even though they're fully renovated, the job is well done. That's not the issue. The issue is because of the high interest rate, new homeowners cannot afford the monthly payments. And so properties are staying on the market for 90 days, 100 days, 200 days. Properties are going under contract and then falling out of escrow because it ended up not working out. And so now, more than ever, realtors actually need us, creative investors, to go in and help them move those properties and help these sellers with creative options, right? Seller finance, subject to whatever, right? But something outside of the box, something other than cash, what they know. So it's a lot of education that comes into play when you're dealing with realtors, and you have to be comfortable, becoming almost like a coach, like I said, right? It's going to take maybe 2, 3, 4 conversations before they warm up to it. The issue is a lot of people are too quick to give up. They're too quick to give up because they're like, well, the agent is very close-minded. The property haven't been sold for 200 days, and this agent is not even willing to listen to me. Not always the case. The problem is they've never heard of it. They have questions. They want to go talk to their broker. They want to go talk to their in-house lender. Some of them have those. Some of them also, 99.9% of realtors, honestly, just have a license. They're not super active. They're not proactive. They're not out there calling sellers. They're not out there sending marketing. They're not out there being proactive, and getting leads, right? So they're doing listings here and there. Maybe you find that one unicorn type of agent that is a go-getter, that have leads, that market to sellers. Those understand, the value you bring to the table if you take the time to explain, and they're open to listen. At least doesn't necessarily mean it's always a good fit. The challenge with the realtors is to at least have them listen and be open to that conversation, and at least try to understand. And once they understand, if it's not a good fit, then it's just not a good fit. But at least they give you the chance to explain and understand the full picture. Okay. So last Saturday, guys, I was in Atlanta and we were co-calling realtors. I was helping my boy Shub. We're co-calling. I was showing him how to overcome objections. And as I'm talking to these agents, I don't necessarily do agent outreach. Okay, that's not my business model. I am direct to seller, and then I do a lot of what is called JVs. So I help wholesalers that have leads, essentially that a cash is not a good fit. I help those wholesalers convert those leads into creative, right? So anyway, we were co-calling, agents that have 90-day listings or more, and talking to them and trying to see if they're open to something creative. Okay. So one of those agents happened to be one that is super open-minded, super creative. She have two properties. Again, like I said before, one of them was a hybrid. And then the other one is a seller finance. What is a seller finance? A seller finance is when a homeowner owns the property free and clear, and they're open to financing you their equity. So essentially, you upgrade that homeowner or that landlord from being the owner or the landlord to the bank, right? So they finance you their equity. You give them a down payment, and then you make them monthly installment payment. What is that does for you as an investor is that you avoid having to go to the bank, put a big down payment, go through this lengthy process of paperwork before you can even get approved for the loan, show your credit, show your job history, bunch of stuff that you do not want to deal with. And it's not scalable because it takes so much longer to buy a property with that process, right? So by turning the seller into the lender, you can deal directly with the seller, negotiate better win-win situations at the same time, and avoid all these bunch of lender fees and going through the credit and all that fun stuff. And so that's scalable because now you can buy more properties at a you know faster pace. Okay. So we talked to this agent and she's open, she's willing to listen. So I go through the subject to uh route, right? So I explained to her what that is. She's super excited about it. She liked the idea. She just wants to understand a little bit more. Okay. And then she brings up another property that she has. She's like, listen, this one might be easier because this one is on free and clear. And the seller is actually open to creative, not to creative finance, but the seller is open to basically doing terms, right? So the more we talk, the more I dig deeper, the more I build rapport, the more I build credibility, explain to her what we do, what type of company we are, the different states that we invest in. We've done this in the past. The more she's willing to listen. So what one of our objections when we talked about the subject to uh, option is that she went back to a lender that she knows, and that lender goes, well, you can't do it. You can't do it because you can only do a loan assumption on a FHA loan or a VA loan. So you can only, what is a loan assumption? Right? So the lender is assuming that whoever she's talking to, whoever that realtor is talking to, is trying to assume the loan, which I'm not. Right? So obviously, like I said again, we just had that first call. Remember, it takes time to help them understand, which is okay. That's where you got to be patient, talk to them more than once until they warm up to it and fully understand and go, oh, now I see what you're talking about. And I'll show you guys one property I bought from a realtor on creative, helped her, she got paid, and we were able to do a subject to transaction. I'll share my screen and show you guys. And then another one also on a VA loan that we bought subject to, brand new property. The seller was a savvy military, financially he's savvy, doesn't need the money. For him, it was just speed and convenience because the military asked him to move, and he only had 2 weeks to sell his property. So subject to, we were able to solve his problem. take the property off his hands. He just bought it 2 years ago, said there's zero equity, right? So his realtor was telling him, hey, if you want to sell this property right now, you'd have to write a check to sell this property. And he's like, what the heck? I don't want to do that. So when I jumped on a call with him and I started explaining the subject to route with the VA loan, we were able to work something out. Okay. So guys, what is a loan assumption? What is the difference between a loan assumption and a subject to transaction? A loan assumption is very literal. You're assuming something, right? So let's say a seller wants to sell you their property and they have a FHA loan on that property. If you do what is called a loan assumption, there is people out here that call themselves creative investors, and all they do is go around and assume loans. They do loan assumptions. What does that mean? So if the seller wants to sell you the house and they have a mortgage on that property, let's say it's an FHA, just for example's sake, okay? What happens is you go to that lender, whoever the lender is, you go to that lender and that lender will underwrite you for that loan and try to qualify you for the loan the same way they qualified that seller in the first place when the seller took the loan. Okay, so you're going to have to go to that same lender, show your credit, show your job history, everything, go through the whole underwriting process, put the down payment, all that fun stuff, and qualify for the loan. So now that loan, move from your seller's name and come into your name. Now that loans is on your credit, on your name. You have to show your pay stubs, all that fun stuff. That's why it's called a loan assumption. You're assuming, you're taking responsibility for the loan. Now is yours, it's on your name, not no longer on the seller's name. Okay, that's what a loan assumption is. That is a good fit for a homeowner that is looking to buy a property from somebody else that they connected to directly, but is not a good fit for an investor. I mean, maybe there's investors out there that does it, but once you understand subject to, it doesn't make sense to go out and do loan assumptions, because I can just go to the lender and get a loan and just go buy myself a brand new house, basically. Right? I don't need to go to anybody to do a loan assumption. I can just go directly to a new lender, get a loan and just buy me a brand new property. Okay. Now, what is a subject to transaction? Subject to is when you buy a property subject to the mortgage in place. Okay. What does that mean? That means, let's say hypothetically, that same seller is selling you their property and there is an FHA loan in place. You come in and you take over that mortgage payments. You take over the payment. So you are, as the buyer, you are now responsible for making those payments, but the mortgage itself stays on that seller's name. It doesn't transfer to your name. It stays on their name, and all you're doing is you're making the payments. Okay, so there's a lot of different tools you can use to make those payments. You can do it yourself, or you can use what is called the servicing company, which is way better. Use a servicing company. They're professionals. You pay them like $17 a month. They will service any loan you want, and they're way more organized. We'll get to that later, right? But essentially, you're just taking over the payments and the mortgage staying on the seller's name. That's where the sticking point is for people, is how you transfer deed and title on the property and the loan stays on somebody's name. They assume that the note, right, the loan, the note, the mortgage, and the deed and title is the same thing. It is not the same thing, guys. It's completely two different things. So you can 100% take over somebody's mortgage payments, leave that mortgage on their name, go to title and close title take over deed and title on the property. Now I own the property and the mortgage stays on the seller's name. I like to use an example that my brother Pace love to use a lot is, let's say hypothetically, when you go to Walmart and you buy groceries, right? When you come and you pay, let's say you have a credit card from Wells Fargo. You come to the counter and you pay for those groceries, right, with your credit card, and then you get the receipt. When you stepping out, you have to show that receipt, right? What is the proof that you own those groceries? The proof that you own those groceries is that receipt, right? But as far as your credit card is concerned, you still owe that money to Wells Fargo, the money that you use from that credit card. But Wells Fargo doesn't own your groceries. You own your groceries. You can do whatever you want with your groceries. You can go eat them, you can go trash them, you can do whatever you want. So it's the same exact thing on the house. So I can walk to you in hypothetically, I'm just saying. I can walk up to you in a Walmart and go, "Hey, I am in such a rush. Like I can't get into the Walmart right now and buy everything I need." Okay? How about you give me this card that you have right now with all the groceries in it, and you give me the receipt. So now I own the groceries, and you let me pay back Wells Fargo. You let me make the payments back to Wells Fargo. Does Wells Fargo really care who's making the payments on that credit card? They don't. They don't. As long as the payments is being made on time, they do not care who is making the payments. So the lien, the mortgage owned by Wells Fargo, guys, and the note and the title and deed is two complete different things. They're not, they're not related. It's not one document. So you can definitely buy a house, leave the mortgage on the seller's name, take it over, and now you own it. You take over deed and title, and you keep making those payments. Okay. Let me show you guys. We did it on this property right here. This was actually, funny enough, is a loan from Wells Fargo, and I helped a realtor actually in the Maryland market move this property because it wasn't selling on the market. Okay, let me show you guys. Share screen. Boom. Give me a minute, guys. Let me show you guys right here. Boom. Share. Okay, you guys can see right here this property right here. So 123 Eileen Road, guys. This is a property that a realtor had it on the market for, I forgot how many days, but it was a really long time. The property wasn't selling. Every investor, every cash buyer that comes to them is offering them really low, even less than what they owe on the mortgage, right? And so the realtor couldn't move it. So when we got in touch with the realtor, I was like, "Hey, why don't you just let me take over those mortgage payments? Let's leave the mortgage on that seller's name, and I'll give the money, I'll give the seller some moving expense, and you still get paid." The realtor actually made $10,000 on this transaction working with us, right? That property, we still have it today, and the mortgage is being paid every single month on time by us, but the mortgage still on that seller's name. And this is Wells Fargo, so we're paying Wells Fargo every single month. Okay, we own deed and title, but the mortgage still on the seller's name. That's the difference between a loan assumption and a subject to transaction. It's like day and night. It's like day and night. Okay, now here's the objection that most people is going to have is you cannot do it on FHAs, you cannot do it on a VA loan. Guys, you can do it on FHAs, and you can do it on VA loans. You can do it on conventional. The only loans that we stay away from, as far as um, subject tools are concerned, is loans that sellers have with like small community banks. We don't deal with those. With those, we do a strategy called an agreement for sale, to where we buy it subject to, but we don't transfer deed and title, because those banks are so small that if you literally call them today, you can talk to the president. So they're more in tune on what's going on with the mortgage. When you take it over, there's the due on sale. There's more chance for you to have the due on sale called upon you on those type of small little banks. So you don't want to mess with the small banks, right? But all the big banks, was Fargo, Chase, Bank of America, all of those, you can do subject to transaction on any property. Another huge objection is, people go, well, if I sell it like that and it stays on my credit and it stays on my name, I cannot qualify for my next property, for my next purchase, which is, again, absolutely another thing that most people don't know is not true. You can absolutely sell your property subject to, leave the mortgage in place, sell it to an investor, let them take over deed and title. Now they own the property, and you can still go out and qualify for a new loan for your new property. Okay, you just need to show and prove that you're no longer responsible for these payments. I have a seller right now. I'm going to show you guys again this property, brand new property. This was the military guy that I was talking about. He sold us this property. The story behind this one right here, guys, is he bought it 2 years ago and he needed to sell the property. And if you guys know anything about real estate, is that, if you bought a house 2 years ago, there's not a lot of equity, right? It hasn't appreciated yet. So his agent told him if he wanted to sell the property, he would have to write a check he'd have to write a check to sell his house, around $15,000. At the time when he was trying to sell it, I think he bought it at 268 and the property was worth around like 278. So if you know anything about selling a home, when you sell a property, you have to pay commissions. There is a lot of fees involved, right? So unless he sold that property for at least 285, 290, there was no way he could cover the commission. So we'd have to write a check out of his pocket for the commissions, right? So he was like, no, I don't want to do that. He bought this property in Maryland, thinking that he's going to stay in Maryland for 7 years. And what happens is 2 years after he moved to Maryland, the military asked him to move to Georgia. This seller is like my best buddy right now. He will give a testimonial to anybody because he got qualified for his new property like we told him. So the special thing about this one right here is that it's a VA loan, guys. If you know anything about VA loans, they don't have to put a down payment, right? This guy didn't have any financial pain. His thing was really a timeline. He has 2 weeks to move. Okay, he doesn't want to pay $15,000 to sell his property, but he doesn't also want to rent it out because he's full-time, high rank in the military, doesn't have time to be a landlord. He's not a real estate full-time investor like we are, right? That's another rule that you want to remember, because there's a lot of people that ask the question, why would a seller do that? Why don't they just take it and rent it themselves? The number one rule in real estate is that you don't want to put your head in the seller's head. The seller, people have their daily occupation. Some people are nurses, some people are doctors, some people are, whatever. They work. Some people work at Starbucks, some people work at Walmart, right? They're not into the real estate business like you are. And so they're not interested in owning a property, hearing about toilet leaks, dealing with tenants. It's something that get them excited. So for this property, for example, when I asked John, now this property was a brand new property, no work at all. I just bought it 2 years ago. When I asked him, why don't you just rent it out and keep it for cash flow? He was like, I have no time to be a landlord and I'm not interested in being a landlord. Okay, guys. So for him, it was like the timeline. Can you close within 2 weeks if title is clear? I was like, absolutely, we could do it. And can you take over this VA loan subject to, right? Because if we were to come in and do a loan assumption, now we have to go through the lender and get do, the whole underwriting process with the lender. It takes a really long time, and then just to assume the loan. So we were like, why don't we just put money in your pockets instead of you having to write a check to sell your house? How about we write you a check so you move out? We take over those payments. You're no longer responsible for it. You leave that mortgage in place, and that's it. You just move on. You just sold your house for full asking, right? Once he understood the mechanics, we're not going to go through, the paperwork, the mechanics in here, guys. We can have another conversation about it. There's multiple videos out here about it as well. But once he understood that, for him, it was a no-brainer. And recently, guys, John literally texted me, and I'm going to show you guys. He literally texted me. He got qualified for his new house, and we still own this property. We're still making the payment. The mortgage is still on his name, and he got qualified. So if you take over a property subject to your seller, if they want to go buy a new house, they just need to prove that they're no longer responsible for these payments on this property. And if you provide that proof to them, which we do because we use a servicing company, the new underwriter will take off 75% of that debt from their debt to income ratio that first year. And the second year, they will take off 100% of it. Right? So John, super happy. Still one of my best sellers. We're still buddies today. Let me show you guys a text message. He literally got qualified. He just got his, dream home that they move into, him and his wife. Let's see. Look at that, guys. Let me show you guys. Give me 1 minute. The text message is loading. Look at that. I don't know if you guys can see that. He said, hey, hope all is well. Just let you know we close on our new home here today. Boom, guys. He got qualified on a VA loan, right? So it's just that misconception that people have when they don't understand it. So it takes a little bit of time to explain people the mechanics, have them understand it, have them understand that this is a legal transaction. There is nothing illegal about it. And once they understand it, then they see there is no brainer. Once they know they're dealing with a credible company, once they know, they feel like you're somebody who's going to say what you're going to do what you say you're going to do. And with realtors, the same thing. They're trying to take care of their seller, and they're also trying to take care of their commission. And they want to work with somebody that can actually perform and not just talk about it. All right. So one, you have to educate them on this whole process. Number two, you have to show them that that you're credible. Number three, you have to be patient with them until they warm up on that. Okay, guys. So here is the difference between a loan assumption and a subject to transaction. Those two are like day and night. Loan assumptions, there's people that does it. There's nothing creative about doing loan assumptions. Okay. And you're very limited as to the amount of properties you can buy doing it that way. Like, for example, guys, Johnny's property, his best friend, when we step into the picture, his best friend, who's an investor, was trying to buy his property. And he was going through the process to do the loan assumption. And John was like, this thing is taking too long. Every day, the lender need new paperwork. The terms is changing. The closing date is getting extended. Every day, they want something new because they're underwriting the guy, right? They're checking the credit. They're checking the job history. They're checking this, checking that. When I step into the picture, I was like, dude, we don't do all that stuff. We just take over the payments and we're done. And once he understood it, he was like, God, this is a no-brainer. So we're like, listen, let's do this transaction. If you're happy with the transaction, then let your friend know he can come and learn from us. And we ended up getting the deal, and he really loved it. We gave him money to moved out with his wife. He didn't have to worry about, cleaning the house or anything. We took it as is. John literally gave us the key before even closing, once he understood the transaction, right? And so, guys, is a huge difference between loan assumptions and subject twos. There's nothing new about subject to. It's been done for hundreds of years. The problem is most people only know real estate through realtors, right? And through maybe the media, maybe HGTV, right? That's why they haven't heard about it. It's not mainstream, but it's been done for hundreds of years. Okay. So boom, boom, boom. There you got it. This was the bold effect, guys. If you have any questions about it, I'm gonna start bringing on guests on my YouTube channel. I'm gonna start bringing on sellers that is gonna come on here that we worked with, gonna give us testimonials and talk about creative finance. And then what I'm gonna do is I'm gonna bring also other guests that even know creative finance better than me, so we can talk about it. I just love creative finance because how many sellers you're able to help by thinking outside of the box and not being a one trick pony investor, right? So, guys, this was the bold effects with Mamadou Diallo. I hope you have a blessed day. Stay hard, stay motivated, stay positive, get rid of the excuses, work on that mindset, go out and help people. Boom, boom, boom. Peace.